This is the ZMAR Podcast. Elite Benefits of America helps small and mid-sized companies with their health insurance programs. And now, your host, Butch ZMAR.
Welcome back to the ZMAR Podcast. We took a small little break, but there are some holidays in between, and we're getting ready for the new year, which means new opportunities not only for us at the insurance agency, but also a lot of the small and mid-sized companies are looking for a greater year, especially after the last 2 years of dealing with worldwide pandemics and restrictions, especially in Illinois and other states that definitely put the squeeze on some of these businesses to generate more revenue. So hopefully we get through the holidays, New Year's, new goals, new everything. And so we're going to get right to it. But with the new year, with business goals, we need to go through a New Year checklist, right? So for you, your HR, your business, you need to go through the checklist. We talked about this all last year. There's a lot of things to work on throughout the year to get you ready for the next open enrollment. A lot of brokers, unfortunately, do this too, but employers just wait until the last second to get things done. So you're scrambling and you just basically pick the high priorities at that moment in time. What's the biggest urgency? What's causing the biggest pain? Usually it's premium, so they focus on the medical benefits only and then don't talk about anything else. And so not only just from an insurance standpoint, offering other benefits that some call voluntary benefits, but the other benefits that make employees stick in the company, but also compliance. Compliance is a big issue. It's coming down the pipe, especially with this federal administration. They're going to find different ways to collect money. I'm going to walk through a process about compensation disclosures that brokers are going to be required to do, and there's penalties involved, so they're even trying to collect from us, as well as the employer because of the Affordable Care Act and Department of Labor requirements, even IRS requirements. They have to collect money in some fashion, so they're going to figure out ways to do it. So we have to button up on the compliance side. May not be able to do all of it at once and may be not cost effective, but you need to go through it as a business owner. And then, of course, technology. Inside our agency, we're moving more and more towards technology. We keep saying we're going to go 100%, and that's just the end of the day. But it's harder to keep doing non-technology products such as PDFs and old paperwork. But we do have clients that are doing it. I'm telling you, you just have to move to the technology platform. It's just like a lot of people use electronic calendars in the beginning when they were still using day planners. It took a while. In fact, including myself, I used to have two calendars running at the same time, a paper version and an electronic version. And then one day I just said, you know what, this is too much. And so went to technology, and even though it had flaws compared to making notes inside of a planner, I never looked back. And so eventually when you get used to it, it's going to be just the new norm. And the same thing with technology inside the workplace when it comes to administering benefits in HR. In this podcast, I want to walk through broker compensation disclosure. There's still information coming out on how it needs to be done. We have the bulk of it, and as of December 27th is the start date, December 27th, 2021. And so we need to, ourselves included, need to start rolling some of this out. Some of our clients are exempt from this, but we're going to make it a rule internally that we're going to make disclosures across the board just to make it consistent. A lot of our other counterparts in the insurance industry that manage property and casualty, so your commercial insurance, your auto, and your home, a lot of them have already done this because they're required to in different spectrum, especially on commercial insurance. So the disclosure is already in there. It's moving to our world. We're going to require sign-offs on it at some point, but I want to walk through some of the things to expect from it. Not only from, at least, I have some clients that listen to this podcast. They're going to at least be aware of what's going on and what they're expecting from us, but also what you should expect from your current broker going forward. It is new for all of us, so there's going to be some training wheels initially, but we're most certainly have to keep moving forward. It is currently here. It may go away, but right now it's here, and so there's a lot of requirements that need to be met. And so for any compensation that the broker receives, whether it's direct or indirect, over $1,000 a year, have to be disclosed. It is definitely much lower. Like Illinois state law used to always say if it exceeds 10% of the premium, then there has to be a sign off. In some cases, that was fine. The compensation level might have been much higher. It just depends on how much premium you're paying. So if you pay $10,000 you had to 10% of that is 1,000. So you would have to have a sign off if you made anything more than 1,000. A lot of cases we didn't, so there was lack of sign off. So we didn't really have to address it, especially in the benefits world. It didn't really apply because we weren't charging those fees or compensation. But now this current disclosure law is now asking us to disclose, even if we're not charging a fee or a consultant fee, it's compensation in general. So whether it's direct, indirect commissions from a carrier, commissions from a wholesaler, whatever it might be, we have to now start disclosing it. It has to be spelled out for services being provided, a description of what those services are, at least in summary, so there's an understanding, and then whether the compensation is direct compensation or indirect. And so if it's indirect, you do have to explain some type of description on there about what that arrangement is, depending on if it's through a wholesaler. It could be a finder's fee. It could be a number of things. Those have to be disclosed. If there's an update, so let's say if there's employees being added, for example, or you make an acquisition and there's a change in the number of employees, which could be directly related to the compensation model. If there's an update, those disclosures have to be updated within 60 days and then obviously provided to the client and then obviously a sign off on it. And so it's a little bit new for all of us. Other channels have been doing it for years. If you go to any consulting or service model outside of the insurance industry, obviously this is status quo. So we're just dinosaurs when it comes to consultation and disclosures just because we've never had to. And so and I'll walk through that in a second, but we just never had to do it, so it's kind of a new thing. But this is going to be for employer-sponsored plans, individual plans. Medicare, there's still compensation. So if we offer a Medicare product, there's still compensation. However, it's under the $1,000 threshold. In most cases, the most you would ever make is $400 and some odd dollars per year. And on average, it's $250 per year per case. And so way under the threshold. Even some of these small groups, it takes multiple employees to be before our compensation's over $1,000. If there's only 2 or 3 employees, there's a chance that it may not. So you may not get a disclosure from your current broker, but just expect it coming forward. And at some point, they may just make it a norm for everybody to sign off. I'm going to walk through the good, bad, and ugly of all this, and there's definitely all of it. So let's start with the ugly. The ugly is the industry. There's industry backlash on this, and this is new for all of us. We've been in an industry that never had to do it. So you're talking about since the first health insurance product ever sold in the United States to the current times, you're talking about over 60 years. And so we've never had to worry about this. And so this poses privacy issues. And then some of the compensations indirectly related to the premiums for the client. So now all of a sudden you have disclosures that could indirectly represent how much somebody's actually paying for their premiums, which could be a privacy issue for some. Others don't care, but for others it could be definitely a private thing. The broker community also feels that, I wouldn't say everybody, but they never had to disclose it. They don't want their clients to know how much they make. And I've always been against this, but I personally know brokers that really felt uncomfortable talking about compensation to their clients just because and they never had to deal with it. And so, but the reality is it should have always been disclosed. It's just now we're being forced to, and there's penalties behind it. Let's go through the bad. We are, in some cases, grossly underpaid for the services that we provide. Happens a ton in our office. Unfortunately, we provide services that we just haven't charged for. We will we will be charging for those going forward in some capacity. It's just that we provide abundance of services and technology and resources that we're not being compensated for. And so there will be a business shift in some ways. Brokers will start charging a minimum now. We've talked about that internally in our office. We're going to start charging a minimum. If you're under that compensation or under that minimum, you're going to pay the difference. Even though it's above the threshold that the disclosures requirement, let's say hypothetically for any small group employer account, an agency might come back and say, we need to generate at least $3,000 a year in compensation in order to pay for the services that we provide for them. Well, the compensation may only be $800 a year. So the broker will most likely invoice the employer the difference of whatever, $2,200 in order to provide that service. And if they don't, then in some cases, the broker is going to say, okay, go somewhere else. In other cases, then it's going to be a limited amount of service. There's software that's available online all over the place. And they have a free version, free forever, or free for a period of time. Whatever it might be, there's a lot of them are free forever, but you cannot call in. You have very limited resources and access to certain things. And then in order to communicate with them, you could only go through a certain channel, and that's it. And so I do think some brokers are going to move down that road, and they're still going to collect or keep the client as long as they possibly can. It's just that they're going to move to a different communication style with that client and service offering. And then anything above that is going to be a charge for. At the same time, you're going to see that clients or employers are going to just take their account to somewhere else where they're not being charged. And I guess that's fair enough. Everybody could do business wherever they want, and the competition is not going to charge. And so, therefore, there's going to be employers out there that are going to say, well, I'm not going to pay the $2,200. I'm just going to go somewhere else. And that's probably an extreme example I gave. Most of the time when we did the math, that we're only talking about less than $1,500 a year in difference on average. And so most employers that we have already spoken to and collected some type of data from, that they think that the services we provide would be worth paying the additional money. But you'll find some employers that are like, no, we're not doing this, we're moving elsewhere, and they'll move the business. So there'll be some business shifting going on. And then there's going to be other ones that will look for shops like ours where we end up charging more, but they're going to get a lot more. And so there's going to be some business shifting on it. And I don't know if that's good. It creates turmoil and confusion in the marketplace, but that's just the way industry trends go. So let's talk about the good. So people genuinely want to pay people for what their time is worth. And so they don't want people that they do business with to feel that they're undervalued in compensation. And so more and more, as years go by in the business that I'm in, more and more people are offering money at the end of the conversation or consultation. They're offering, in fact, some of them beg to pay something, because that's what people expect. For years, we got compensated by the insurance company. They were basically getting our services for free on their behalf. It was already included in the premiums. Well, some of them are willing to pay double or triple what we're actually compensated because they see the value in it. But now they actually could see how much we're actually getting paid, and then there could be a discussion made based on compensation levels. The clients will know more about expectations on both sides of the services. A lot of times when you have something for free, people keep demanding more. And so they keep wanting more because they know they're not paid for it. You don't call your attorney, ask for additional advice when you know that there's going to be either a retainer involved or an hourly charge. But you certainly will call your broker and milk them out as much as you possibly can. And so with the disclosures, this is good for both parties, in my opinion, is that there is now a level of expectations for services, and it creates boundaries. Because what happens is, even in our current office, just being compensated by commissions, we do a certain service for the insurance companies to minimize the call volume and workload of the insurance company by doing it at the broker level. So we get compensated for that. And so that is the scope, right? And so if you call us up and say, hey, we need a template for 125 document, or we need a template for employee handbook, or you need disclosures and those are resources that we have, right? So now you're going back beyond the scope of what the insurance company is really compensating us for. So therefore, we should be compensated for that because we're paying for that service. In some cases, we make enough on the case. At a certain point, there's, in lack of better terms, a law of diminishing returns. And so we're compensated a certain amount. Anything above that is good for us. We could provide more value in time and services to our clients, but at certain points, we could provide those and not have to worry about any charges. But you may notice that some of those boundaries will be set, and then everybody's on the same page. Service consultants have been doing this for years. They give a scope of what the work is, how much the charge is going to be. If it doesn't match the scope, in some cases it can be pro bono and they write it up that way, but in other cases they have to charge more. They put a stopping point to the project, saying you're asking us to do more than what the scope of the service was, and now you write up a different agreement that both of you agree, or they move on or decide they don't want to do it. And so it happens in all other areas of what we do, especially in our work or our business, but we don't do it for insurance products. And this is going to change that. And in some cases on the bigger scale, so if there's a broker that has a client that they're getting paid a hefty amount, so in some cases brokers are overcompensated for what they're actually providing. And it could be not only, a broker could make six figures or, several $100,000 on account, but in other cases it could be $15,000 or $20,000. And for the amount of work and services being provided, they may be grossly overpaid at $15,000, $20,000, and then grossly underpaid for for a broker getting paid $250,000 a year on account. So it just depends on the level of services that are being provided. So, but there's a lot right now. If you ask your broker how much you're getting paid, you're going to start realizing that you're getting cheaped out on some services that other brokers will already give away or provide some element of resources for, even if you have to pay for it. So that there's definitely that. And then obviously there's indirect compensation, especially on the bigger accounts, especially when there's over 1,000 or 10,000 employees. There's bonuses that are involved that are unbelievable. I mean, more than what the original compensation package is. So now that has to be disclosed too. And so this could really be a game changer for some of the employer models and how the brokers are getting paid, especially when they find out how much they're actually getting paid for the services that are there. So, but I'm not saying that they're not worth the money. I'm just saying that, it needs to be disclosed. It needs to be outlined. So, and again, the reason for this podcast was to let you know that it's new for all of us. Expect some growing pains with it on both sides of the channel, but also realize that there may be some changes in how the relationship is with the broker, and this could be good and bad, but expect more as we move forward. And most certainly, obviously, it'll engage the broker a little bit more, so you can either dive into the relationship a little bit more and make that connection a little bit stronger, or the opposite and find another broker that you definitely connect with and have the expectations outlined and what's supposed to be met.